Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
So thanks for having us, Seth. Really appreciate it. Met Seth, I think, about a year and a half ago. Probably the same time we met you guys, right? On the Summit Cruise. So as Seth mentioned, we're from Dallas, Texas. First time to Nashville. So far, so good. No problems yet. But you want to maybe do a quick introduction about yourself, Tamiel?
Sure. So Tamiel Kenney. Mark and I have been married 23 years. We started buying small multifamily. He started with his identical twin brother just before we got married, and we continued the process after we got married. We have 2 children, 10 and 13, a boy and a girl. They are way cool and like this big now. And like Seth said, we're from Dallas. We actually live just north of Dallas and in Frisco, Texas, which is a major booming metropolis. I have a background as an executive admin as well as an RN, and 15 years maybe volunteering for a 501c3 medical missions team where I've been to Nigeria and Guatemala. So that's kind of my background. Back to you.
Cool. Thanks, Tamiel. So I'm going to, Tammy will sit back there and she'll correct me if I make mistakes. I think it's probably what will happen typically, so she can jump in there.
Okay. Peace out.
But I actually have a lot of kind of content to go through, probably a lot more than normal, but I thought maybe 2 ways to approach it. One is just kind of have a couple main topics, points, and the other one is to go through a bunch of stuff, and you might pick up a couple points by doing that. So I do have a lot of content. The title really is How to Go Big with Apartment Investing Without Starting Small. So kind of maybe to set it off, how many people in here have invested in apartment buildings before? Just a couple, and I know it's Paul, right? Paul just bought a 32 unit, I know. How many units other people have? Anyone have 100 units or above? I know Kevin's in a passive investor, syndicated deal in Atlanta. Has anyone in here raised capital, raised money from other people? Is it Billy or Billy? Just one person? Okay, so all right. So we'll talk a little about that too. That's one way you can go faster without starting small, by the way. Because eventually most people will run out of money, right? People say, I'm going to buy a deal, and then 2-3 years later use the money and buy another deal. Well, there's only so many years in your life before you run out of time, right? So using other people's money is a good way to go. So I'm going to go through a lot of stuff. Just as Tamiel mentioned, as our kids, there's no doubt this is my why. I'll go through my background just kind of briefly as well in a minute here. But I grew up in Michigan, one of 7 kids. Tamiel mentioned I have an identical twin brother. Didn't grow up with much at all. Pretty much started buying everything myself when I was about 10 years old, bikes, clothes, everything like that. And I'm like, this kind of sucks, actually, for a kid to have to buy their own stuff at 10 years old. So I said I need to do something different, but I didn't know what that would be. But I went to Michigan State University for accounting, was CPA for a while. But while I was in college, I said I need to do something different because I don't want my kids to go through kind of some of the pain I went through from a financial perspective. We had food, and we had a place to live, which is, Tamiel's been missions trips. That's more than a lot of people have in the world. It's true. But we also had a lot of embarrassing times as kids, which I didn't want my kids to go through. So I was 22 years old, probably 21 at the time, made an offer on a small multifamily, got accepted, and ready to go. My dad talked me out of it. So I remember I was sitting, this was 25 years ago. I remember I was sitting at Hardee's restaurant, and the booth I was sitting in, and I felt like an idiot, because I was like, man, I had to walk away from it. I trusted my dad. He was trying to help me, but at the end of the day, I figured he really wasn't the person to listen to. He's 81 now, never bought a property ever. So tells you something about what he's done in his life for real estate. So a couple months later, I actually bought a property anyways and didn't tell him until after I closed. So he couldn't talk me out of it that way. So I've been in a couple books, not because I used to kind of think writing books, people are doing it for their own ego or whatever it might be. The books I've been in really more to share my story, some issues we've had. There's really nothing I won't share. I'll share, if you're talking to somebody in real estate and everything's all hunky-dory, nothing ever goes wrong, they probably haven't been in it long enough, because eventually something will go wrong if you do enough deals. We have about 3,500 units right now, and we'll be in 5 states, so we have a number of units. And we did start small, as Tammy mentioned, but there's really no reason to, and I'll kind of tell you how you can go bigger. So this was me. I had a CPA I mentioned, then I was in IT. So I worked on a software called SAP. It's a pretty large, very large, multi-billion-dollar company. And I started my own IT company in 2008. And I was doing pretty well. Had projects, Marathon Oil, T-Mobile, Lockheed Martin. So some pretty big customers. Had projects all over the world. Slept literally about 3 hours a night consistently. And worked about 85 hours a week. And totally ignored Tamiel. Any hours I had available, which really weren't many, I spent with the kids, because I said they're little. And they're going to eventually get bigger. I need to spend time with them. So I ignored Tamiel. Caused a lot of problems with us early on. I shouldn't say early on, for a long time probably, really. But it was kind of more, I said I made a decision to go bigger with apartments, but the truth is Tamiel made a decision for me that you either do something different or things are going to get not good. So I said, well, how am I going to do that? I'm working 85 hours a week. But it took us about a year really to get our first deal. And it was really because I didn't have much time. And I know a lot of people don't have much time, but I really, like I said, slept about 3 hours a night. So it caused a lot of problems. And I said, okay, now I need to just make it happen. So started getting involved in meetups and going to events. And it took a while. It was frustrating, but then we kind of got going. And now it's much, much easier. We'll probably do at least 15 deals this year, 2,000 units. And it's because it's gotten easier because of our track record and having relationships with brokers and things like that. So that's a little bit about me. So the traditional way, I'll just put this up here. People are like, I need to start small. I talk to people, and I bet you 70% of them say I'm going to start with it's either between 1 unit and 20 units. And there's nothing wrong with that. Paul did a 32 unit on his own, which is great. But I can guarantee as much time Paul spent on 32 units, you could buy 500 units, spend just much time. It's the same amount of time. So again, nothing wrong with that. We started small. People say I won't start unless I have all the money. Well, the fact is, people that do this all the time, we have people in our group that we've helped. Patrick Duffy, we started helping last year. He's 29 years old. He did 4 deals. He had no money, couldn't raise any money, but he was really good at analyzing deals and really good at finding deals. So he literally quit his job. He's 29 years old. He still does work. He asset manages the properties. So that's the other thing. If you talk to somebody, say, "Oh, retire, don't do anything." I mean, yeah, Seth took a month vacation, but he probably can't take a 10-year vacation probably right now. Maybe, I don't know. Maybe he can. But most people can't. You're still going to be doing some sort of work. So, you need to know it all before you start. People are like, I don't really feel like I really know what I need to do. Well, okay, there's more information. The problem is now there's too much information out there. And the other issue is then people that actually try to teach you very limited information. They don't tell you the whole story. It's typically for self-serving purposes. They don't want you to know certain things because, either takes away the value they see in themselves, where it might be. We share everything. We share horror stories. We share mistakes we made. We share every aspect. Billy's talking about financing. A lot of people don't even know that we talk to, been in groups for years. They don't even know what bridge financing is. They don't know what interest reserves are. They don't know what rate caps are. They don't know how HUD financing works, all these things. And so for me, our whole goal has always been teach every single aspect of it so you're informed, and then you make a decision what's best for you and your investors. I shouldn't be telling you what's best for you and your investors. I will tell you from experiences what's worked, what hasn't worked, but we want to share everything. So know before you start, you need to be good with numbers. Anyone in here love numbers? So just a few. I know Kevin's wife probably does. She's a CPA, or she's an internal auditor, I guess. So I was CPA for a while. I'm good with numbers just because it's the way I was made, right? But I could say anyone that's not good with numbers, because only three people raised their hand, I guess, that actually like numbers. There are certain things you can do to at least, if you're going to invest in anything, I don't care what it is, at least get knowledgeable enough to make an informed decision. And it's very easy to figure out very quickly whether a deal on the surface makes sense or not. in a matter of minutes. Like literally a matter of minutes. Whether it makes sense on the surface. It doesn't mean whether you should invest or not. You need to do more digging on that. But there are certain rules of thumb you can use and certain things you can look at and certain criteria you look at before you invest. So better, I'm going to put them all on here. Start big. So we have people that we've helped. The smallest deal in our group that someone did is 90 units. That's pretty good size for a first deal. And we did a 454 unit deal. And I can tell you, other than raising money, I will admit, it does take longer to raise more money. It's just a fact. And I say that in some cases, I'll say it's actually the opposite. If you go talk to people that actually have money, family offices or whoever, equity groups, a lot of them won't give you a check less than $5 million. In some cases, it's $10 million. They won't invest in anything unless you have an investment at least $5 or $10 million. So they do that. Why do they do that? Well, they know they have to spend this much time to look at a 2-unit property, analyze it, things like that, versus a 500-unit property. So they're going to do due diligence on the sponsor, the person putting the deal together. So there's no reason you can't start big. People are doing it all the time. It's kind of more, I tell people you can start big unless you don't have any money and you're not willing to partner with anybody. If you're willing to partner with somebody, then you can start big. It's really endless. Partner with others that have money. Do what you're good at. I love the UFC, and you look at different fighters. In some cases, very early on, fighters were one-dimensional, and Gracie, for example, he's 170 pounds, and he's kicking everyone's butt that's 250, 300 pounds, like literally, right? He's one-dimensional at the time, but the fact is, he was really, really good at something. He couldn't do anything else than that one thing. With real estate, I think you want to get knowledgeable in every area, but get really, really good at something, whatever that is. If you can raise money, raise money. People in our group, all they want to do is raise money, a couple guys. They don't want to go find deals. Other people say all I want to do is actually analyze deals. So get good at analyzing deals or find deals, whatever it may be. Get really, really good. And the reason you do that, because people will be drawn and attracted to you. If you're really good at something, you'd be surprised how many people will find that out. It's a small world, and then be drawn to you. And then you're now getting involved potentially in a lot more opportunities because of the skill set you have. Leverage someone else's story. Talking to Kevin too, and in general, a lot of times people will say, well, I've never done it before. And Kevin even said, right, well, I'm a syndicator. I invested passively in a syndicated deal, right? I said, well, that's a story. It's 270 doors, is it, in Atlanta? Is this a true statement if Kevin says my partners and I are investors in a 270-unit deal in Atlanta? Is that true? It is, right? Now, if someone says, well, Kevin, are you a general partner and not, or the manager? He can say, no, I'm not. But you're not going to probably get to that point. He can start using that as part of his story. Now, if you don't have any story at all, then find somebody that does. People in our group can say, I'm partnering with, Think Multifamily. They have 3,500 units. They're in 5 states. The person talking to the broker could be brand new, never done a deal yet before, but they have someone's story they can leverage. Now, it needs to be true. I used the example. I was at a hockey game with one of the brokers in Dallas, and he said, oh, yeah, so-and-so said they're partnering with you. And I said, no. I met the guy once ever, and I'm definitely not partnering with him. So that guy probably lost a lot of credibility with the broker, I would imagine, by saying he's partnering with me, because I'm not partnering with him. So why become an investor? So has anyone not seen this from Kiyosaki? It's just a quadrant: employee, self-employed, business owner, and then investor. So I'm going to put some numbers up there. And what are the red numbers? Anyone know? Tax rates. Yeah. People are like, no, that's not right. Well, if you're an employee, depending where you're at, these are rough numbers. 40%. Self-employed, you have more expenses, right? More things you have to pay. It could be up to 60%. Pretty high, right? If you're a business owner, roughly 20. If you're an investor, you can be 0. And people are like, no, I don't believe that. So anyone in here actually make more than Donald Trump, you think? Anybody in this room? Probably not. I'm going to put my hand down too, because I don't. The fact is, if you remember the debate, he was with Hillary, and Hillary's complaining about how Donald didn't pay any taxes. And Trump interrupts her and said, that makes me smart, which I would say it does make him smart, right? He's paying 0 taxes. So the fact is, when you invest, the government wants you to be an investor. There's no question about it. They incentivize you to be an investor. We literally, for other reasons too, we paid 0 taxes, federal taxes last year. First time ever in my whole entire life I didn't pay any federal taxes. The reasons for that. We can get paper losses, things on paper, right? That can, depreciation and cost segregation, which I'll talk about here in a minute too. But this is all on paper. So to be able to pay no taxes is a pretty cool thing, right? So now you might say, well, I have a W-2 job and things like that. I'm not a professional investor and things like that. Well, that's fine. But the fact is you can at least reduce the amount of taxes you're going to pay. So when you look at investments, you're comparing real estate versus stock market or another investment, you should consider the tax consequences of that because there's a huge difference there. So it's possible to pay zero. I'm going to put real estate versus stock. So I used to invest a lot in stocks early on, early 20s. It's the only thing I really knew. I did invest in real estate too, but majority of my money on my 401k and anything through work went through to the stock market. The thing I don't like about stock market, it's not tangible. I can't touch it. It's a piece of paper. Real estate, I can touch it. I can drive by it. I can feel it. Everybody needs a place to live. Now, whether they live in your place or not, would depend. But everyone needs a place to live, unless you're going to live on the street. So everyone's interacting with real estate, and that's what made sense to me early on. It was like everyone needs a place to live. Some people never can afford a house, and some people don't ever want a house. We lived in an apartment for 4 years. Not because we couldn't afford a house, it's because we were in a walkable community. It was really cool. We could just go downstairs and walk everywhere. So real estate's tangible. If you invest in a syndicated deal, so who in here has invested in a real estate syndicated deal, like as a passive investor? So just like three, okay, 4. But you have access. You know who the sponsor is. You know who the manager or lead is of the team. So if I invest in Coca-Cola and I get the financial statements and I say, I have a question about their expenses here. I'm pretty sure I can't call the CEO of Coke and ask him a question about the financials. Probably not going to happen. But if you're an investor, limited partner, member, they call it really members with LLC, is a limited partner in it, then you have the option to have access to the person putting the deal together, direct access to them. And then income. I don't think I have it in here, but there's a chart I usually show where the stock market is just literally, it's a roller coaster. There's literally no logic in my mind. Probably people in here actually have done well in stock. A lot of people probably haven't done well in stock. So I'm not saying you can't. I'm saying for me personally, it makes no sense. There's no logic in it, and I don't like the volatility of the stock market. So I'm going to put this, just an acronym up here. So why real estate? The acronym IDEAL, so it's income, you get income, depreciation, which is just a paper loss, right? Generally speaking, property is not going down. Can it go down? It could. But over time, if you're taking care of the property, it will go up, and it's gone up over time, enough time, right, in the history. You have equity. You have appreciation. 2 types, really. One is forced appreciation, where I put money into the deal and I can get the revenue up or expenses down, or it may be. And you have market appreciation. So can anyone here really control market appreciation, you think? What thing's going to happen, what cap rate's going to be? I mean, the fact is that market appreciation is the least thing you can control. Nobody can control what the market appreciation is going to be. So I put a lot less stake in that. And then leverage. So with multifamily in general, and any real estate class, do you do just multifamily, Billy, or do you? Okay, so like self-storage and so generally speaking, multifamily is typically the highest leverage for most of the deals for lending. Yeah. So we get 75, 80% leverage. In some cases, you get even more if you do a bridge loan. We just did a bridge loan. We closed actually today on the deal. It's 85% leverage and 100% of the rehab dollars rolled in. That's pretty good. And the rate on a bridge, and I won't go into all the details, you need to understand it, it's typically higher for sure, but we got 5.89% bridge rate, which is very, very low, without a doubt. We have another one that another guy, our partner, had is 11%. So huge, huge variation there. But the fact is leverage. And people say, well, what does leverage really matter? Well, if you run 2 analysis side by side, and I think I might have a slide on this, your returns are much, much higher with the leverage. It's just a fact. Now, is it riskier? Yeah. If you own a property all cash, that's less risky than having leverage. But if you have enough attributes or characteristics and data points you're looking at, there's risk involved in any investment, without a doubt. But you can do some things to help mitigate that. Tax savings, I talked about a little bit. I'm just going to put it up there. So depreciation, you have cost segregation, which if you haven't heard of, is really just breaking a building up into components to where you can depreciate certain pieces of the property and building in, like, say, 5 to 7 year depreciation, which allows you to take more expenses earlier in the deal with the whole intent of hopefully getting your taxes down lower and lower. My experience has been typically about a third of the purchase price will be in the 5 to 7 year, which is pretty good. You get the expense out a lot quicker. Bonus depreciation has been there for quite a while, but end of last year it changed where it's even better. So it allows you to take even in the first year, there are a lot of rules that used to be there that are no longer there. And, Trump's a real estate investor, right? So this is definitely one of the things that was added last year that makes a huge difference on your first year, what you can take for expenses. So I tell people, get advice from a CPA. I'm a non-practicing CPA for sure. I don't even do my own taxes. But the fact is, there are a lot of ways to get your income down. That's the whole goal. I mean, I'd love to be able to say, I pay no taxes. That's what I want to be able to do. Single family versus multifamily. I'll put this up here too. I'll just kind of hit these very quickly. You don't really have that, good over economies of scale, generally speaking. We owned like 14 units and we managed them. We evicted people. We did work on them. With our multifamily, we have a third-party management company that manages the properties for us. We don't get calls for evictions or maintenance or anything like that at all. So I actually feel less work now than I did. With 3,500 units, I have less work now managing them than I did when we had 14 units on our own, and it's just reality. Recourse versus, Billy was talking about, non-recourse. So we probably have about $100 million in loans right now, and it's all non-recourse. So I say no personal liability, but that's not totally true. Generally speaking, with a smaller property, you're going to have recourse to look at you individually, your income, and then you have personal liability. With the agency debt that Billy was mentioned, for example, Fannie Mae, Freddie Mac, you don't have, it's non-recourse, but if you do something bad, like fraud or whatever it may be, then you still have liability. They're called bad boy carve-outs. So, that's one thing to consider too as you get involved. And some people say, hey, do you want to sign the loan with me and things like that. Your risk isn't zero. It's definitely diminished with non-recourse, but it's not zero. And a lot of people just tell you it's non-recourse, you have no personal liability. That's half the story. You can have liability if you do something wrong. So you need to be aware of that. The biggest one, without a doubt, is the way it's valued. If you look at, let's just say, 4 units and below, so 1 to 4 units, the value of the property is going to be based on the comps in the neighborhood, next door, wherever it may be. I could have, a 3-bedroom, 2-bedroom, or 3-bedroom, 2-bath house and rent it out for $10,000 a month if I wanted to. And it's like, oh, that's great for rental. I mean, it's like huge. And, well, it doesn't matter. If someone's going to go buy the house, they're going to say, I'm going to pay you based on what the house next door is selling for, the house down the street. With multifamily, so 5 units and above, and there's really no reason in my mind to go even, to go bigger, but 5 units and above is based on the value. So if they run it as a business, it's based on the net operating income, which I'll talk about in a minute here. But think of this, and it's no joke. So for every single dollar I can increase my revenue or decrease my expenses, doesn't matter, my net operating income goes up. So if you take $1 divided by the cap rate, it's the way you're going to do it, and I'll show you this in a minute. So the dollar divided by, let's say, 6.5 cap, whatever it may be, that's like $15 of value. So literally, if I have a property, I increase my NOI by $1, Dave will give me $15 for that. Every single dollar I do that for. This is something that I made up. This is the way it works. So if you get nothing else out of the presentation, without a doubt, understanding this one concept, you might still choose, well, I still want to do smaller properties, and that's fine. But at least get educated and know why you're doing it. But if I can make $1 and get someone else to pay me $15 for it, I'll do that all day long. And that's the way, I'll show you an example of this too. So this is just a formula. Net operating income divided by the cap rate will give you your value. So that's where I was mentioning every single dollar I can increase my net operating income. So net operating income, I think I have, is essentially your revenue. So it's everything. It's the rent I collect. It's pet fees. It's other fees, utility bill back, all my revenue. minus all my expenses with the exception of one. It doesn't include my debt payment. So it's revenue minus expenses, not including my debt payment, will give me my net operating income, or your NOI. Okay, you take that, divide it by your cap rate. And if you do a little bit of math on this, and you take a cap rate of, let's say, 8% NOI, and then do a cap rate of 6%, you're going to see there's a huge, huge difference in that value. Okay, so, but that's reality. And the reality is, you can't, people say, oh, I'm going to buy this and change the cap rate. Well, you can change the NOI for sure, but you're not really going to change the market cap rate in the submarket. You're not going to change that. The market is what it is. So, but you can change the NOI. So cap rate essentially is, what would I make on an annual basis for return if I paid cash for a property? That's all it is. So no debt, no leverage. So what would I make on an annualized return? So I don't even know. In Nashville, I would probably a Class C, Class B properties, probably a 5.5 cap. I'm guessing probably right now. That's about what Dallas is right now, below 6 for most Class C properties. 4 years ago, it was 8.5 cap. So literally take $100,000 divide by the 2, and you see the value has gone up like this. Now, is that going to happen forever? No, probably not, right? But the key is if you can still cash flow, that's key. People are like, well, what am I going to do 5 years from now? I have a 5-year plan. I'm going to sell my property. Well, if you are still cash flowing, you can make your payments and things like that. Maybe don't sell your property. Ride it out, right? So people are like, I made money. Same as stock. People say, I made money today in the stock market. I lost money in the stock market today. Did you sell any stocks? No, I didn't sell anything today. Well, you didn't make any money or you didn't lose any money. It's the same with real estate. Cash flow, in my mind, even more importantly now than ever, is king for sure. And if you need to look at it from your evaluating a deal. If you see a deal that's coming in with a cash flow a little bit lower and they show you on a 5-year return, they're going to be way high returns. I'm not saying it's not possible, but the fact is they're probably banking on a lot of things happening that they have zero control over. That's what you need to be concerned about. So here's 200 units, $50 a month is $10,000 a month, right? So $120,000 a year, increase in NOI. So if I came in and was able to increase rents by $50 a month, of course I can't do that for existing tenants. They have to renew or new tenants coming in, but just assume I did that. It's $120,000 increase in NOI. Like, okay, well, my property went up $120,000. So how much do you think I think I used probably an 8 cap, 7 cap. How much do you think this increase in value of the property? Someone else would pay me. I made $120,000 in a year. How much is someone pay me for the same property? Anyone guesses? Yeah. So I think that's probably what I have in there. So yeah, 8 cap. So that's conservative, right? If you do a 7 cap, 6 cap, that's more realistic. You're going to be closer to the $2 million mark. So literally, people are like, well, I don't understand how that works. Well, that's the way it works. People will actually literally pay me because it's a business. They'll pay me based on the net operating income. So if you own that property yourself, your net worth just went up $1.5 million. That's how people start building huge, huge wealth. And say, well, what is that? Yeah, but it's on paper, which it is. Well, we just did a property, 208 units in Dallas. We owned a little less, about 2.5 years. We pulled out 80% of all the equity we had into it on a supplemental loan. And it's, depending on how you do it and things like that, it's at least tax deferred. People say tax free, but reality at some point it catches up to you, right, when you sell a property. But the fact is, you can do those things and not have to pay taxes on them then. So that's not bad. Pull 80% of the money in 2.5 years and still own the property. That's good. This is a real example. I'm just going to put it up there. And this is, and you guys are probably pretty similar in Nashville, but this is a property. It's 255 units. It's North Dallas. 2 years ago this month, September, we bought it. $15.4 million. Haven't put hardly any money into it. It's worth well over $23 million right now. And this one, yes, a little bit of market, but this was really more from a management play, operationals perspective. So they're, without going into detail, something called economic vacancy and things like that, but they were probably, their economic vacancy was double of what the market should be, about 23, 24%. It should be about 11% probably. So even by coming in and changing the management, we increased the value of the property significantly. And these aren't numbers made up. This is reality. You take our what's called a trailing 12, the T12, and do numbers on that. Even in a 7 cap was worth $23 million. We paid 15.4 for it. So that's huge. These are old numbers a little bit too, but it's 155% return, and that was less than a year. So we're looking at doing a supplemental loan on that one as well. So that's great. Yeah, okay, you've done that. And the fact is, a lot of people are doing it. And I tell people it's not, people that sometimes teach act like everything's so difficult, so hard, so, oh my gosh, this is like, I have the secrets for everything, right? Well, the reality is that Tamiel and I didn't invent apartment investing, right? And nobody else in this room or anyone teaching today, they didn't invent it either. But the fact is, there are certain things you can do that will definitely make you become more successful, faster, and be able to go bigger if you choose to. People do it all the time. And a lot of it has to do with, people say, I listen to podcasts or read books, and that's great. You should do those things. But it's all head knowledge. I mean, it's like, I use the example again in the UFC. If I'm trained for 3 years as a fighter, and Kevin comes in and reads books for 3 years, pretty sure I know what's going to happen. He won't even know. I mean, he doesn't have the experience, right? First time you get punched in the face, it's like, okay, well, that doesn't feel very good, right? Well, I don't know. If you've been punched before, you might say, oh, okay. Some people get jacked up buying, actually more excited about it. So reality is, it's great to have knowledge. There's so much knowledge out there. There's a lot of misinformation out there too, which is really kind of, sometimes I do videos once in a while. Tammy's like, you're probably a little bit, you need to calm down a little bit, because I'm like, I'm frustrated. I really am, that people are teaching things that are either wrong or not teaching things that they should teach, and just reality. So how do you get started? Number one is really a fundamental question to ask everybody: are you willing to partner with somebody, yes or no? And that could be for anything, right? And we know people, right? There's a doctor that he kept trying to, get in our group and things like that. And he's like, hey, I think I'm going to partner with somebody. And I said, you're not, right? I mean, he's a control freak at the, nth level, right? And he's like, there's no way I could partner with anybody. I said, yeah, okay. So now you know that you can buy, generally speaking, you can buy based on your own net worth and your liquidity. So the general rule of thumb, it can vary depending on which agency, things like that. But if I get a $5 million loan, my net worth needs to be $5 million or more. My liquidity needs to be $500,000 or more, or 10% of the loan amount. Just a general rule of thumb. If you say, well, that kind of stinks, I'm nowhere near there. Well, then find somebody that is. I'm signing on 2 non-recourse loans right now for other people. One is for the experience, and the other one is because the guy filed bankruptcy in 2009. He's experienced, has done a lot of deals, but he can't sign the loan. It's a Freddie Mac loan. They won't let him do it. So, number one, will you partner, yes or no? If the answer is yes, then it's endless. Now you need to figure out, well, what's your criteria? Where do I want to buy at, location-wise? Well, I only buy where I live. We're in 5 states. It's harder going into new states, for sure, to get started. Once you're there, it gets easier. And then physical attributes. Do I buy, a building that has flat roofs? Maybe not. A chiller. Anyone know what a chiller system is? Wow, okay. So I'm going to tell you, in case you ever look at a building. So only one person raised his hand, but so we own a chiller system in Dallas. So it gets pretty hot in Dallas. Do you think in July and August, pretty hot? Yeah. So we have one system that cools all 208 units, and it heats it. So one system does that. Well, fortunately for us, July and August last year went down for 3 weeks. So that means all 208 units were without AC. Not ideal, right? Not a good situation. So then you're buying AC units and doing things like that, right? So, but that's the property we pulled 80% of all our money out in less than 2.5 years. Do I like the chiller? No. Would I do another one? Probably not. So that's a physical attribute. So people are like, well, I'm just going to start getting all these deals sent to me. I can tell you, people are like, oh, I don't have any deal flow. If you could talk to brokers, get on their mailing list, you're going to have more deals you possibly can even look at. It's just a fact. So make sure you have a criteria. We were horrible at this. Looked at every single deal that came across my desk and didn't have a criteria really, which causes buy like an 8 unit, which we still own, which has gone up a lot in value, but it's all cash deal, which I never do again. But anyways, it's physical attributes, partnering, and then make your goals realistic. You need to stretch yourself. We wanted to do 2,000 units last year. We didn't do it. We didn't meet our goal. We did I think maybe 1,400. Still good overall. I knew 2,000 was a stretch. This year we'll do probably at least 2,000 units. So, but I'm not saying I'm going to do 10,000 units this year. I mean, it's possible, but really not probable probably. So make it realistic. That way you're not having a goal so far out there that you just give up, right? Make it realistic. I talk about this, education, lots of ways to do it. How to find good deals. It's easy to find deals right now. I mean, I could give you 10 deals, in the next hour, ping brokers and say, send me deals. No problem. But chances of being good deals are very, very low, right? It was very hard for us getting deals and then trying to weed through them. Now it's a lot easier for us because a lot of the brokers know our criteria. We tell them what it is. We went to Atlanta. We struggled a little bit trying to prove to the brokers we could get deals, and we ended up closing several deals last year. We did 4 deals in a 6-week period in Atlanta. That gets the brokers' attention. So now we have 2 more deals totally off market and a 3rd deal they're giving us, if we want it, that are all off market deals. Now, does that mean we're getting a steal of a deal? No, we're not. The fact is there really aren't steals of deals out there right now. It's still competitive. But the fact is we got to get into the deals before anyone else got into it, and they're very good deals. They meet our criteria and our investors' criteria, and that's all I'm looking for. If we can make our projected returns, that's the goal. We don't have to make 30% returns a year because those deals really aren't out there right now. Very few out there anyways for that. So how to find deals. I mentioned leverage relationships. If Tamiel was brand new and she called the broker and said, hey, yeah, I'm looking for deals, and they're asked about her background, she's like, oh, I'm just getting started. That's probably one reaction from the broker. Or, hey, no, I've been buying, started buying 25 years ago, 3,500 units. We're in 5 states. We're doing 15 deals this year. Probably get the broker's attention a little bit more. Just reality. If they go talk to the seller, the fact is we have properties. We're selling 3 properties right now in Atlanta. I would never, ever sell to a first-time buyer. Ever. Unless they just had a suitcase of cash, literally, and they're going to pay way above what we're asking, I wouldn't do it. I'd have no confidence in ability to close a deal. So it's just reality. People are like, well, that's not fair. Well, it's reality. And people say, well, I've done a lot of single family. Well, go talk to a broker that specializes in 100 units or above, or 75 units and above, and you're going to get 0 credit on your single family. Is it fair? No, it's not fair, but it's reality. They don't put any emphasis in it because the fact is they think it's so different. Reality is the steps are very similar. You think it's way different to buy 100 units versus a single? You still do the same thing, right? You get financing, you drive by, you do a contract, you do all the same things. But there are definitely differences, and it is a lot more complicated to do multifamily, but it's not hard. It's complicated because it's new. Anything you do that's new is complicated. I mentioned have others introduce you if you can. It's great for us. If we go to a new market, we'll have brokers in Dallas introduce us, and they're basically telling the other broker, you'd be stupid not to talk to Mark Kenney or whatever. So it's just like they do a better job making that introduction. Just reality. And then I mentioned partners and I. That's the strongest thing. So like I said, Kevin, you're using your messaging. If you go you try to syndicate a deal in the future, and people are like, well, I don't have any story. Well, he kind of was discounting. I'm not trying to. You kind of discount a little bit being a passive investor, but he has a story. He can say, partners and I own 270 units in Atlanta. So that's building your story. What makes the market ideal for investing? So I will preface this that you don't necessarily have to have every one of these criteria in my mind to make the market, to invest, essentially. But population growth, Nashville is going to hit a lot of these, by the way. Population growth, job growth, right? Dallas is the same thing. Landlord friendly, how easy is it to evict? If I go to California, a guy, no joke, talked to him last week. He said, I'm buying a $1.1 million single family in Sacramento in California. He's from Ohio. And I said, oh, okay. I said, well, some of the laws around evicting in California? He's like, I never thought of that. I'm like, are you kidding me? Like, you're spending $1.1 million on a deal and you don't know the eviction rules? California, horrible. Some of the places Northeast, horrible. Does it mean you should never buy there? That's for you to decide. I won't buy there. Low to medium housing costs, multiple industries. So this is where some industry, especially in Texas, where we're at, it's oil, right? So you go to certain cities, if the oil is not doing well, then they're not doing well. Or you go to certain places that all they are is military. So especially if it's military that can be deployed, not ideal, right? Something could happen. Your property value could go way down because of that. Obstacles to new supply. So there's a lot of property, a lot of new buildings going up in Dallas, but a lot of cities we look at, the entry to supply, they can't really build new apartments because the city doesn't make it easy for them. That's good, right? City investments, and then the other one's going to be development investments. So, and I don't know if you have locations around the Nashville area, but in Dallas, we have certain areas, South Dallas in particular, where the city's putting a bunch of money in there. New libraries, and I don't even know why they have libraries anymore, but anyways, new libraries, new fire stations, things like that. And then, but no developers, no investors actually want to make money they're not doing anything there. And then you go to East Dallas, for example, we own a property. The city's really not making investments, but developers are tearing everything down they can get their hands on and building new buildings. I'd much rather be in a place that someone's actually trying to make money, is putting money into it versus the city. Now, again, you don't have to have both of these or any of them, but the fact is those are things to look for. Weather, grew up in Michigan. There are a few places in the Midwest right now I think that are good places to invest. But if you look at kind of a lot of the people where they're moving, it's south. Right, weather's a big factor. And the other one I don't think I have on there is rent control. So there's certain areas across the country that the city actually will tell you what you can rent for. I don't think it's any of their business, frankly. They shouldn't be telling me what I can. The market should determine what someone's going to pay for it. So California has some areas of this. Chicago has it, but that's kind of the norm, South Chicago. But the fact is, you want to be aware of all those things before you invest. Again, you don't have to have them all. Doesn't mean if you don't have one of those that it's a bad investment, but those are things we look for. Find deals, call brokers, get on the mailing list. You can get on the mailing list and tell them exactly what you're looking for, essentially. And you'll get deals sent to you, probably more than you even want. Just reality. You get a bunch of deals sent to you. Meet them in person if you can. LoopNet. Anyone here use LoopNet? Yeah. It's addictive. Okay, yeah. So it depends what you're looking for. If someone tells me all I do is look on LoopNet for deals, I'll tell them probably not the best if that's the only thing you're looking for. I never look at LoopNet, not because it's bad, but I just don't. The deals we're looking for typically aren't out there. But the fact is you need usually more than one thing. Talk to brokers. People are like, well, I'm never going to talk to a broker because everything is listed as overpriced. Well, maybe you get a relationship going and get an experience and you're not buying things that are listed anymore. You're getting them before they get listed. And people are like, well, it takes time to build that relationship. It does. But again, if you have partners, you can go much faster. You're here at events, meetups. I think Seth was mentioning Bigger Pockets. Become a member of local. And then MLS is kind of really for smaller, but you might have some out there once in a while. Personally, and the other one, people say I'm going to just call sellers. Well, all the brokers are calling sellers. So only my philosophy on this, if I spend all my time trying to go to sellers directly, I build all these relationships, and then someone comes in, which happens all the time, a broker comes in behind and says, well, I think I can get you, $500,000 more for the deal. All the time I spent building the relationships with the sellers is pretty much useless. I'd much rather spend time with the brokers. And I'm not saying you can't do all these things, but don't discount brokers in my mind. That's where you're ultimately going to be able to get bigger deals. I'm just going to put this up there. I'm not going to go through it directly, but I mentioned, let me go one more here, that you can really run through a deal literally in a matter of like 2 minutes, and I'm not joking. You really only need two pieces of information from the broker or seller or whoever. All the other information you can use are defaults or rules of thumb. All you really need to know is my gross potential rent and my other income. If I know those two pieces of information, everything else I can put on there. Will this tell me, yes, I'm going to go buy the property? No. But it will tell me, hey, is it even close? Hey, it's $11 million. They're asking $15 million. Probably not close enough to me, right? They're asking $11 million. Or I'm thinking $11 million. They're asking $12. Getting closer. So maybe I'll go in deeper and figure out, hey, is it really a deal or not? But I just tell people that there's literally 2 minutes you can run through this, and I'm joking, to at least give you an idea whether I look at it further. So why would I do that? Well, when you start getting more deals sent to you, you get 5, 10 deals a day sent to you. Probably don't want to analyze all those. It's going to take a long time to analyze all those deals in detail. So maybe you only do one of them, whatever one looks best. How to raise money. I think there were a few people that said, just a couple said they're raising money. Raising money, so, and I'm not joking, probably, I remember 2 times my entire life asking my dad for money. I was petrified asking for money. My brother and I hiding out in the car because we were 9 years old and we needed winter coats in Michigan. You think a winter coat's probably pretty required in Michigan? Probably so. Pretty cold there. He loved me, stuff like that, but the fact is money was always a big issue growing up. So for me, I didn't want to ask other people for money. It was, I felt like, now I look at it, and I'm not joking, it's like I'm providing opportunity to people that most people don't even know is available. It's reality. Now, they could still choose to say, well, I'm educated, I listen to you, I don't want to invest, and that's fine. But if you're going to just try to get money from people, you talk to people that invest with us too. I talk people out of investments. I don't think this is a good investment for you because what you're telling me what you're looking for. I talk people on a regular basis to put less amount in investment. He's like, oh, I have, whatever. I had a guy that sold a gym. He had $900,000. Like, I'm going to put it in your next deal. I'm like, please don't. Please put that up like over multiple deals. The best deal on paper going in, you use all the information you have, could turn out to be a bad deal. And unfortunately, my experience has been, it's usually not the property that's bad. It's people that do bad things that make the deal bad. So any good deal, great deal, could turn out to be a bad deal. We have one experience. I wish I never had an experience with it, but I do. Experience with a partner that stole money and did a bunch of other stuff. And you're talking litigation and mediation and literally hundreds of thousands of dollars, not thousands, hundreds of thousands of dollars. Not a fun experience. So there are ways to avoid that. Stuff I could have done to avoid that. But raising money, you want to present an opportunity. You want to find out kind of what you invested with before, right? So if Billy says, hey, I invest in the stock market and I love it, it's so volatile. Well, okay, good for you. If he says the opposite, or he says, well, I'm really looking for consistent cash flow and I don't really have stocks that pay dividends. Okay, well, maybe a good cash flowing deal is good for him. I never really try to convince somebody to get in a deal. You're trying to educate them about the deal, the things you like about it. And people will ask me, and I'll even admit, like, well, what do you think the risks are involved in the deal? I think they're expecting me to say, well, there are none. I'll say, every deal I've bought ever has something about it I don't like. It's reality. We're buying 1970s and 80s buildings and things like that. So there are, you're better off being transparent with people, being upfront, and I'll tell you, telling people, well, this is what, the risk might be here and there. We have people all the time that say, well, how do I guarantee you get all my money? Well, you don't, unfortunately. Or how do I get out after 5 years? Well, depending on how the deal is structured, typically it's like, well, you can't. You can ask us to get out. I had a guy, no joke, that wanted to get out of one of our deals just recently because I guess he just wants money, and the property is going under contract. And I'm thinking, yeah, I'm more than happy. You want to get out. He's kind of a little bit of a, you're going to get a paying investor here and there too, unfortunately, but just realize that if you have them. I'm thinking, I'm more than happy to buy you out if you want to get bought out. We're going under contract next week. He knows that too. And not a long story, but he wanted to buy the properties is what happened. So he's upset he didn't get to buy the properties. I'm like, hey, I'll buy you out before you put in if you want to. We're going to make 35% in 18 months. We'll do that. But the fact is, when you're talking to people, understand what their goals are, listen to them, try to put them in the right investment. Don't just try to get money from everybody because at the end of the day, it's going to be short-sighted. So how do inexperienced people raise money? It's kind of I talked about leverage someone else's story. You have your own story, which could be like, hey, I have no real estate, but maybe you do something. Maybe you're, there's certain professions, doctors. Maybe I'm in the military. I'm a CPA, whatever it might be. If you don't have any of those, okay, that's fine. Then you have the deal itself, what's good about the deal, and then you have your team, if you have a team. So leverage all those things. Don't discount something because you think, oh, I've never done real estate before. It's okay to say, well, I'm partnering with other people who have been doing it. I'm part of a team, just like a business. I have one part, other people have different parts, and that's why I'm partnering with other people, so we can do this together. It's okay to say that. Why debt is good. So this is just an example. So on the far left, paying all cash. Far right, I think it's 80% debt, 20% cash. In this example, this is a real example I ran through, and it will vary depending on the deal, but 10% return on investment versus 20% return on investment. That's why, and this is good debt. Good debt to me is I'm buying it to buy something that produces income, and ideally it's non-recourse. Prefer not to have any recourse debt. So that's good debt in my mind. Questions before you invest. So sponsor or lead is kind of the person putting the deal together. Passive investor is the people basically investing. And I would say this too. How are we doing on time, by the way, Seth? Okay. I would say this too. Just let me know when we have like a few minutes left, I guess. But with passive investing, I just talked to a guy yesterday at the airport and said, "Oh, I talked to this syndicator, a guy putting the deal together, and he said that if I invest with him passively, I'll learn everything I need to know about investing in real estate." I'm thinking, and I know the guy he's talking about. It's a good friend of mine. I'm thinking, that's not true. I told him it's not true. I said, you're going to learn, like I'm not kidding, you're going to learn, if you want to go do your own deal, and being a passive investor is great. Like I said, Kevin can leverage his story and use that for his track record. But reality is, if Kevin only invested in a passive deal and didn't have any real estate experience, he's going to learn about 1% of what he needs to know to go syndicate and do his own deal. And I'm not joking. So if someone is telling you to learn all these things, you will learn. No doubt about it. You'll learn what a PPM, private placement memorandum document is. You'll learn monthly reports that come to you. But that is so small, knowledge-wise, what you need to go syndicate a deal. So if someone is telling you that, they want your money. And I would tell people, it's good to be a passive investor. Lenders like it too, right? You can put it on your real estate own schedule. Here are the properties I own. As a let's say it's a passive investor, might only own 1 or 2%. That's okay. They still like that. So, but just call it what it is. It's good for those reasons. It's not good. It's not like you're going to go from there and go syndicate your own deal. It's not reality. What does a sponsor do? Well, they build teams, and the teams are pretty big. You have accountants, you have attorneys, you have cost segregation people, you have property management companies, you have due diligence teams, you have lenders, you have, all these different things. It's a lot of time to do that. They're going to find the deal. We used to use about 1 in 100 deals that really actually made sense. About 1% of the deals we look at actually would make sense for us. That's pretty low. They are higher now just because of the brokers giving us deals that meet our criteria. But the fact is that people are like, well, the sponsor, lead put the deal together and they're taking an acquisition fee, whatever it may be. It's like, well, do you think that's like the only deal they looked at and they just went out and did it? The fact is they probably looked at 100 deals to get that one deal. I mean, you might spend 500 hours trying to find a deal. Like literally. It's a lot of work. They negotiate the deal, pay fees. So if you're going to syndicate, there's a lot of people get hung up too. They'll say, well, I want to do a deal. I want to syndicate it. I don't have any money. Say, okay, well, find somebody that does. Because the fact is you're typically going to put 1% of the purchase price down as earnest money. So, 1% of that. And then you're going to do, you're going to pay potentially attorney fees. So a range, whatever it may be, figure maybe $20,000 for that. You're going to pay due diligence fees. So figure about $50 per unit, to have someone go look at it, inspect it, and things like that. So there are fees you have to pay out. Now, what happens if I actually walk away from the deal? Now, me as a syndicator, all those fees I've paid, with the exception made of earnest money, depending on, I'll talk about that in a second, are gone. Or I may have paid attorneys to a contract, I paid fees for due diligence, and I got there and said, man, this is not what I expected. Because there's 100 units, I'm only looked at 2 or 3 before I went under, going under contract. So they're probably going to show me the best 2 or 3 they have there. So a lot of fees potentially. Raise money, invest themselves, loan financing. This is much different on multifamily that I mentioned. A lot more involved, but there's a lot to it. And I would mention, are you a mortgage broker, Billy? Is that what your role is? Or are you a banker? Commercial lender, yeah. So you want to talk to someone like Billy without a doubt, because the fact is that you're going to get lost with all the different options. There's so many more options related to it. And there are terms like yield maintenance and the prepayment penalties and things like this that, and I said bridge loan, people, their minds are blowing sometimes with that. Bridge loan, your attorney fees are 3 to 4 times as much. You have $50,000 you're going to pay in a rate cap. Well, I wish I would have known that before I did a bridge loan, right? Well, why don't people tell you about these things? Do you do bridge loans or not? You do. Okay, so he does everything. So someone like Billy, you want to talk to, because the fact is you're going to have to. I don't think you work for free, do you, or do you? No. Okay. So Billy doesn't work for free. Don't expect him to, but he's going to have a couple things. One, he's going to try to put you in the best program, and two, he's going to have more clout with the lenders than any of us would going single by ourselves. So that's going to give him more leverage. And if you bring an experienced sponsor team, then a lot of the exceptions that the agencies will do, you're going to have more likelihood to get those exceptions. So we've gotten, we get 5 years interest only on several of our deals. A very new sponsor coming in, maybe that's not as likely to get that. So there's certain things you're going to get by being more experienced. Profit and loss are going to be responsible for going over like the trailing 12 profit and losses, balance sheet, the general ledger, things like that. They're responsible for making sure that's accurate. And then property tax consultant, which is, I don't know how Nashville is, but in Dallas, property taxes, they're very aggressive every year. So if you buy a property, you might be paying close to 90% of the purchase price times your mill rate for taxes. But you need to know that. So people try to buy properties, they don't realize that. We know that. We bought a property, I mentioned 255 units in North Dallas. Property tax, I think, about $150,000 when we bought it, and they went to $280,000. It's a lot. But we knew that. We knew the way it works. And it's different every single area of the country. We buy in Memphis for cash flow. There's a pilot program. Our property taxes are cut in half and frozen for 10 years. That helps with cash flow a lot. And they only reassess every 4 years. So understanding that. So how do you say, well, I don't understand any of that because, I don't know any of that. Well, there are guys that do it across the country that will give you good faith estimates of what your property taxes will be. And ask them for both years. Don't ask them, hey, I'm closing like in September 2018, and they give you the estimate, and it's like next year it goes way up, right? Because you want to know for 2 years. Same with a property manager. If you get a budget from them, I always recommend you get 2 years budget from them, not just 1 year. What to look for in a sponsor, their track record. On our website, too, we have like 22 questions you can ask before you invest. Now, you don't have to ask all 22 questions necessarily if you don't want to, but the fact is it gets you thinking about things to look for before you invest from a sponsor. Their track record, knowledge of the area, is a sponsor investing money, relative. Typically, the sponsor is going to have, in some cases, a couple $100,000 or more into a deal up front for earnest money and due diligence and attorney fees and things like that. So that's something to look for. Go Google them. We know a couple guys, and it's like, man, I wish people just would Google this guy because this guy's pretty bad, And I don't think most people would invest with him, but he does deals, So now, with that said, you might want to, if you find something, you might want to ask, because I know we do loans too, so they do these checks on you. The lender does, and believe me, I've unfortunately been in litigation. I told you about the partner and things like that, but I had 3 lawsuits show up from Atlanta. I'm thinking like, well, Atlanta, I buy there. From 2013, 2014, I was never even there in Atlanta. But it has Mark A. Kenney. That's me, but they're not me. So be careful what you find on Google too, because it might not be for that same person. References, finding out how they are to deal with, their Rolodex. So it's a little harder, right? If we go to a brand new city and we're getting investors, that's not as attractive to investors, really, right? If I say, well, I own 1,500 units in Atlanta, but using the same property management company, that's more attractive. It doesn't mean that we're going into Florida for the first time. Now we're using this huge property management company you've been working with for over a year, so that helps. But the fact is, all things being equal, it's riskier. It's a new market for us. The reputation, kind of just how they deal with their experience with loans, and Billy may not want me to, I don't know how he works or not, but I can tell you right now in the last 3 months, we've closed 10 deals, 10 loans this year, and even the last 3 months, lenders are retrading basically more, where they tell you one thing, here's what we're going to give you for a loan, and then lo and behold, 3 days before closing, well, we're going to give you like a couple $100,000 less. I don't like that, right? And what's your recourse? Go yell and scream at them? They're like, who are you? I mean, they don't. So that can happen. So be prepared. That can happen. You need to know that's even more now than normal. That they use a third-party company to do due diligence. So we bought a property in Atlanta back in June, and we're going to use the same property management company because they manage our other properties for us. But we didn't have them do the due diligence. We hired a third party because it wouldn't make sense to me to use them. People are like, well, it'd be a lot easier and faster to have them do it. Well, yeah, it would be, but they're already there running the property. So we had to pay for them. We hired a third party due diligence team to do that. Just some questions, I have like 3 out of 22 out there. Have you been voted out as a lead? What kind of financing you're pursuing? You're signing the loan? Like I used the example of a friend. He filed bankruptcy almost 10 years ago, and he literally can't sign on his Freddie Mac loan. So I'm one of the KPs on that deal and part of the general partnership team on that deal, but he brought me in because he couldn't sign the loan. So, but I personally don't have a big issue that, it was 10 years ago someone filed bankruptcy, but you might. I know a guy that had DUI when he was like 22 years old. He's 40 years old now. Maybe that's a big deal for you. It's for you to decide, but ask questions. The people are like, I'm not sure I can ask you this question. I'm like, well, our minimum is like $50,000 to $100,000. So I'm asking for maybe $100,000. You can ask me questions about the deal, me personally. So don't feel like you can't ask questions. Now, if someone says, well, I don't want to answer that question, or you ask for something like the trailing 12, financials for current financials, and they say, well, we can't share that with you, I wouldn't invest. I know people that won't share that. Well, why aren't you sharing that with me? Right? You're asking me to invest in a business. So you want to ask good questions. Like I said, you don't have to ask them all, but ask good questions. So passive, you'll see only, I think, 2 are lit up. They invest, right? In order to be a passive investor, you have to invest. And then optionally, potentially, sign on a loan. So maybe you come in, you want to get experience signing on a loan. I personally wouldn't sign on a loan just for the sake of signing on a loan unless I want to do something with that. Meaning I want to go do my own deal eventually. Well, that's valuable. Or maybe I'm getting pretty well compensated for doing it. And this is my personal opinion, I wouldn't just go sign on a loan for someone because they're your buddy. And now you're putting your name on a loan, even on recourse, something can happen. I would only do it as a stepping stone to do something else. That's just me personally. So a lot of people will say, well, I'm going to become accredited. Well, accreditation or not isn't something you just become or not. It's you are or you're not. So you have to have $1 million or more net worth, excluding your house, or you have to make, if you're an individual, $200,000 or more for the last 2 years and reasonably expect to continue to do it, or $300,000 the last 2 years if you're married and reasonably consider to do it. So you say, well, that stinks. I don't meet that criteria. Well, that's okay for some deals. Some deals, if you're not accredited, you can't invest in it, period. It's 506C. It's Reg D, 506C, if you look it up. They can only take accredited investors. That's it. So some deals you're going to be discounted. You can't even invest. So you want to ask that question before you start spending time looking at a deal if you're not accredited. So you say, well, I'm not accredited, but it can be sophisticated. So the 506B allows people to bring in non-accredited, 35 or less, non-accredited, and it allows, the person has to be sophisticated. Now, basically means they understand the risk involved. You're supposed to have a relationship with that person first as well. But this is all like ambiguous. The SEC doesn't really tell you how long it needs to be, what the relationship needs to be, things like that. But just keep in mind that like there are some people that can't invest in our deals because they either like, hey, I expect to get, there's no risk involved, or they expect it to be like, I have never invested in anything before, I don't have whatever it may be. So you have to fill out a questionnaire. So you might not be able to invest in some deals, and if you want to invest in deals you're not accredited, then become sophisticated by learning different things, understand the risk. So this is really the last slide. So good timing, I think. So how do you get involved? A lot of people say, I'm going to go find a deal. I'm going to do the whole thing, soup to nuts myself, steps 1 through 14. That's fine. So it takes you more time to do that. But it's great. That's what you want to do. People do it all the time. But maybe you get involved another way. Maybe you have pretty decent net worth. Maybe you have high liquidity. A lot of syndicators don't carry a lot of liquid assets, right? They want to invest it. So you might be able to bring in your balance sheet and sign on a loan and maybe get compensated for that. Maybe you are good at raising capital, so you can raise money for people, and some SEC laws around that, how it works, but there's a chance you come in and be part of a general partnership and get compensated for that. So those are ways you can kind of get involved. We have people that all they want to do is put earnest money down on deals. All I want to do is put earnest money down on deals for people that don't have the money to put it down, and they get a small piece of the deal for doing that. So there are a lot of ways to be creative, to get involved in a deal. Even if you're you're 1% of the deal or whatever it may be, 0.5% of the deal, you can still start building your story and saying you're part of the general partnership for that project. So those are ways to get involved. So I don't know if a Q&A, Seth, or is it how you want to start?
Yeah. Let's everybody give it up for Mark Kenney, by the way, for a fantastic presentation. We'll grab a couple stools right here. How many people learned something they didn't know before they woke up this morning? Yeah, I definitely did. Thank you, Mark.
Welcome.
Very well said. I got a few follow-up questions I would love to discuss, and then we will definitely open up to audience questions as well as questions from our people watching online. So we may have one or two of those. But can you talk a little bit about, let's start with an easy question. What is your most common real estate book that you would recommend to people?
So I'm a researcher, basically, so I research a lot. I know Kenny McElroy has a couple really good books. You know Kenny, right? He has a couple really good books, easy to read. Rich Dad, Poor Dad isn't really necessarily a real estate book, but a mindset book as far as how real estate and being an investor can help. And then, but I'm more a researcher. I research stuff all the time.
So do you have a favorite that you would most commonly recommend?
I think Kenny McElroy is probably a pretty good one.
Which book?
Which one is the
ABCs?
ABCs, yeah.
Yeah, so the ABCs of real estate investing, right?
Yeah.
It's by Ken McElroy.
Right. We have a passive investment book we're putting out, and it's really because we think that's kind of been a lot of the syndicators don't want to talk a lot about all the stuff around passive investing. So a lot of things we put in there that people, in my mind, skip over.
Yeah, I love it. Can you talk a little bit about, because obviously it's incredible, what you've accomplished in a relatively short amount of time in this in terms of just amount of doors and everything. Can you talk a little bit about maybe this is going to be sound like a strange question, but I think it's a good question to ask. Do you have a favorite failure moment? And what I mean by that is failure can be a valuable asset if it changes the way that you change your behavior, perspective, or something that you learn from. So in that sense, from all of this, do you have a favorite failure moment that you would care to share?
Yeah, so that's one of the things we do share, and I'm okay sharing any failures because the fact is that I can help someone save potentially time, money, energy. Everyone goes into thinking nothing will go wrong and things can go wrong. But it's the one I mentioned. We had a partner we done a couple deals with before, and he already owned a deal. And not to get too into details, but he already owned a deal. He had an LLC set up, and we ended up taking out one of his partners into the same LLC. So the name stayed the same. And there's certain reasons why you might do that, reasons why people do that. I did it once my entire life. I'd never do it again. What happened on that deal, he turned out to be a bad dude, unfortunately. And things that were never recorded on the books and things that were from even 8 months ago before I even got involved in the deal that never were shown or anything like that were now my problem. So the fact is, you buy into existing LLC, it doesn't matter. You can have everything you want in a contract. If people are going to try to sue you, they're going to sue the LLC. And in this case, that's what happened. And so a bunch of liens and things like that came up, and they were from months and months before I even got involved in the deal. But it didn't matter. We booted him out. We had a board of directors, booted him out. But the fact is, I was getting called from vendors and creditors and things like that, and
that had nothing to do with
way before I got involved, never recorded on the books. Now say, well, that's not fair. Well, it's not, but I would never invest in an existing LLC. Always create a new one, which we do for all our properties. This is kind of unique, the reason why we did it, but I personally would never do it. I'm sure someone else has a story went perfect for them. They do it for taxes usually, for property taxes not to go up, but that's not enough a reason to do it in my mind. This is a real life story, still living the story. And, it's a big headache.
Well, that's a good answer. What is something that is working for you in this business right now?
For me, I think two main things that we've always tried to do, even for people in our group, is like I want the most educated people on the planet. I'm trying to be, I do, because education and experience, and then be easy to work with. Not a pushover, but easy to work with. So brokers come to us all the time because they know if we're going to ask for something like a credit from a seller like that, it's a really, really good reason why we're doing it. So being easy to work with, being most educated, and then just treating people fairly. I don't care who they are.
Yeah, you touched a little bit about, are there types of investors, like how do I not become one of those investors that you don't want to work with?
Yeah.
Basically.
I haven't had a lot, fortunately. Fortunately, I haven't had a lot, but there are a couple. And I think you probably get a little bit of just a conversation-wise. You kind of know a little up front, but one guy brought in, we're raising $6.2 million between Thanksgiving and Christmas, and I had a cruise on December 10th. So I think looking back, I probably shouldn't have brought him in, and he wasn't a big investor, but I brought him in. But I think as a syndicator, it's okay if people ask questions. If you want to ask questions all day long, but if they're asking questions like, well, "What's my guarantee I get all my money back?" and then you tell them, "Well, there isn't," and then they have a response back to that, you kind of get those indications. As a passive investor, there's certain people I won't let invest in our deal. If you want to invest in deals, I would say become educated, because it's a lot easier for me as a syndicator. Understand that there's risk involved and be able to say, yeah, I know there's risk involved and things like that. But education's key, and then being realistic that things don't happen overnight. It's a business.
It's good. So a little bit of an ethereal question, but interested to know your response. If all of this stuff, for whatever reason, not that it's going to, hypothetically just fell apart, and you had to start from square one, you could do anything you wanted, you have all this knowledge and experience that you currently possess, all the relationships, where would you start?
Probably a race car driver, for one, but if it all fell apart, but probably wouldn't do very well at that. For me...
And doing this again could be an answer, too.
Yeah, no, I know what you're getting at. No, I would. I love real estate. I've loved it ever since I was little. Started doing it, when I was in college. For me, it'd be a lot easier. Start over. It is all about the relationships. And I think for us, it's really getting the deals is kind of the key. And if it's a good deal, the money will come. So to me, the number one thing is having a relationship with the brokers understanding what you want, what you like, what you don't like, and you'll be easy to work with, and you're going to close a deal on time, and you'll have more deals than you possibly can even handle.
It's good answer. Can you talk about and you don't have to share maybe personal details, but you really drove home the point. I think it was a great one to identify. You have to define your criteria on the front end. For you, is that something that kind of flexes over the years as markets kind of go up and down, or are you kind of like, I need to see X amount cap rate? Like, how do you define that for your own
No, it's a
deals?
good question. Our criteria from a physical attribute has changed. We used to buy older buildings now, and I'm not saying we never will, but we look at newer for us, mid-'80s, late 80s, which is still older, but it's newer for us. That's one thing from a physical attribute. But as far as the expectations for returns, I mean, I'm an investor too. My expectations have come down, but some investors haven't gotten there yet. So I think as you're looking at investments, people compare it. Well, 2 years ago I bought a property for $40,000 a door. Now it's $65,000. Well, does the deal still work? We bought deals, where people made millions of dollars. Well, we're making millions of dollars potentially on the deal if we sell or refinance. So criteria has changed physically, for sure, and just more of the clientele. We've had, don't be surprised. I'm not kidding. You buy a Class C property, it can happen in Class A. It could, but someone gets shot on the property, murdered, where it may be. It can happen. So we're trying to buy a little bit better assets physically, and then a little bit better locations. Crime's huge. People think, and Billy could tell you that your loan options go down drastically if there's high crime. It's just a fact. So
that was good because I was gonna follow up that question with, are there classes that you would maybe recommend somebody go into? Do you avoid certain? It sounds like you're kind of starting to maybe with some of the lower C class.
We're B's and C's right now. We look at probably more B's if we can. We do avoid mostly A's, not because they're nice to look at, but the returns, generally speaking, are just lower.
Real quick, can we define that? Because I know it's a little bit vague, but for some people who maybe, no listener left behind.
Yeah, sure. So think of kind of more of the professionals living there. So they're going to make, pick a number, 100,000, 80,000 or above. Usually there are other attributes to it. If it's a brand new building, doesn't have any amenities, people could argue it's not an A. But think of a new building, has some amenities, maybe fitness center, pool, or maybe, and it's newer, 10 years or less, things like that. A B would just be a step down from there. So it's people making a little less money, maybe not as many amenities, and it's older. So it's going to be you'll see different people say this is A or B like that, but say it's 90s and below, down to like a 80, right? And then C is lower income than B's and C's, more working class. Maybe they're making, pick a number, 40,000 a year. Probably not as many amenities, and it's your 70s and below as far as vintage when they were built. And those are just rules of thumb. People can argue what they are, but at the end of the day, you kind of look at the attributes of it and say it's A, B, or C. And cap rates are tied to that too. If you look at the way properties are sold, you look at like CBRE's cap rate report, it'll have it by A, B, and C.
It's good. It's a good answer. Well, I know the group probably has an absolute ton of questions. I can keep asking questions all day long because I have them. But I'm just going to open up to the room. I'm going to walk around with the mic. So just raise your hand if you got a question. Got Billy over here. Oh, yeah. Sponsors get to ask the first questions.
Thanks for coming down, by the way. Learned a lot here. All right. So first question is new construction or existing?
For us?
Yep.
Yeah. For us, we've only done existing. I like new construction for some of it, but we actually tried to help a guy once do new construction about 2 years ago. And it's a little bit unique the way it was. It was triplexes, and they're building 100 of them in Houston, things like that. But we had very little interest from our investor pool. And it was paying a 15% preferred return, which is phenomenal. But it was more like, I don't like the risk involved with new construction because too many things can change in the market. But for us, we'll probably end up doing new construction at some point. We're looking at doing one right now in Fort Worth area in Dallas, but for us, it's been existing.
Yeah. Second question is off the cuff here. What's the largest amount of money that you've raised for a deal, and how fast did it take you to raise it?
$6.2 million, and we did it probably in maybe 6 weeks or so.
Okay. So last one, this is more how to explain this. So you get acquisitions fees for the sponsor fee to kind of pay them. You also have management fees. I have people that on the investor side get a little ruffled when you charge a fee to pay yourself. How do you explain that to your investors going, well, what's that 2 or 3% fee for this, and
right.
why are you charging that?
Yeah, so Billy's referring to up front, a lot of people will take a one-time acquisition fee based on the purchase price, 2-3%. We usually take 2%. I don't apologize for it anymore, frankly, because of the amount of work involved. So I'll say, well, this isn't the only deal we got. I'm a full-time investor. So if I'm not making any money from, the acquisition fees, it's a job. Just like you get paid for your job, I get paid for the job. And it's not like I just found one deal. I had to look at, 50 deals to get the one and spend 500 hours of the time to get the one. So it's to sustain the business, right? So you're going to have some investors, certain groups around that teach that, acquisition fees are, from the devil, basically, so never invest in a deal. I invest in deals too passively, and I don't have any problem with acquisition fees as long as it's reasonable. But I think you explain that's your job. Now, if it's not your job, you can say, well, I didn't look at just one deal. I looked at, 50 deals to get one. I spent, several hundred hours. It's work. It's part of my job. Just like you get paid for your work, I get paid for work. Do I take a lower fee if it's not a full-time job? No. Because I was actually doing this in addition to, full-time IT job. The work was still the same. If people are really pushing back on it really that hard, I just find different investors, frankly, because they're taught something. They go up to the Northeast, they charge 5% acquisition fee. That's a bit much in my mind, but it's work. It's your job. It's a business.
Good answers. We've got a question from online from Victor Menashe, actually, one of our former speakers.
I don't want to answer any questions.
Question from Mark. When you are investing in older properties, they can experience more than their share of equipment failures, i.e. water heaters, air conditioners, refrigerators, washers and dryers, windows. I just learned chillers, I'm assuming, is a part of that. How do you decide how large a budget and how large a reserve to keep for these kinds of surprises?
Yeah, good question, Victor. And Victor and I looked at a property that had a lot of maintenance on it too. To me, there are two aspects to it. One is that the lender is going to require reserves, generally speaking. I mean, Freddie doesn't necessarily require it, but they're going to generally require $250 to $300 per unit per year. So if you have 100 units, $30,000 you have to put away per year with a lender to count for some of these things. I would say, to kind of answer Victor's question in particular, hire a third-party due diligence team to come in that's going to look at everything, and I mean everything, right? Don't say, oh, look at just a sampling of these things. So get that up front, find out what it's going to cost to repair it. And at the end of the day, you can overraise. Like, there's no reason you can't overraise for something. But if you're buying an older building, you generally speaking, you're not going to get more rent for replacing the AC unit unless it just doesn't work. So I'm of the opinion, well, don't replace it, right? I mean, especially if they're paying their own utilities or things like that. But I would say you get a number from due diligence team and then put a contingency factor on top of that. Things will always come up no matter what, whether you want them to or not. But and then taking samplings of, if all the AC units are bad, then you need to account for that. If they're like 5 to 10 years old, then you're over a certain number of years, you're going to replace a certain number of them, and just do math on it and figure out how much you're going to need for each of those. But as much as you can raise up front or get from the lender for repairs and maintenance and capital expenses, I would do that up front. That way you're not having to worry about it or try to do a cash call later and try to get money from people. But hire professionals that know what it's going to cost to do it is the biggest way.
It's good. More crowd questions? Back in the back.
Mark, you talked early on in your presentation about customer-focused management when you're talking about adding value or increasing the value of a property you own. Can you give some specific examples around customer-focused management? What's that look like?
Yeah, so it's an example of the one we bought. So, end of the day, it's like if you go to a restaurant, right, and the hostess is there or whatever, and you're just like, why do they hire her? Right? She has like an attitude. She's not personable. She's not. So when you have people that are on site on a property working there, they're the face of the company essentially, right? They can literally make or break the entire operation. So to me, it's having someone that's friendly, that actually walks around and looks at things, not just sitting in the office all day long, but also is firm enough to say, hey, we're not gonna allow you not to pay rent, and then stick with that. But we heard it, right, from people that live in these buildings, and the biggest thing they're looking for, as strange as it sounds, is respect. And we've heard examples of people that are like just talking to people, just respect us. Don't treat us any differently, treat everybody else. And in some cases, they might be paying $800 a month or whatever it may be, so it's a little bit working class. And there's other things you can do, like have monthly parties. They don't cost really anything. Have things for the kids to come, have like hot dog cookouts, things like that. So most management companies will all say they do that, but reality is a lot of them don't. But I think at the end of the day, and then have it, even for us, we get feedback all the time, like, what would you want us to do differently? Some things are easy to change. They say, well, I really wish, whatever, that the vending machine was like over there or something, you know what I mean? Things like that. Some things are easy to change, some things aren't. But being open to get, say critical feedback or constructive criticism from people, and then seeing if they see that you actually listen to them and change something, and then also allowing them to personalize certain things. Like you might have it where literally one wall, it's bizarre. We had one, I'm not kidding, someone paid $50 extra a month to have a wall painted. And that's ridiculous, someone would do that, probably not the norm. But the fact is, you say, well, hey, you live here and we have 3 different colors you can pick for your accent wall. What color would you like? So it gives them an ability to kind of personalize a little bit, is big for them because it's their home. So does that kind of answer your question?
Thank you, Mark. I am curious, somebody who is a newbie, what amount of time should they be spending between you had a list of what somebody could and should be doing between building relationships, raising private money versus finding deals? Yeah. Do you have a little guidance on that?
Great question. Yeah, how much time? If you want to syndicate, do your own deal eventually, what you're looking to do? Yeah. So I get this question a lot, and I tell people no one has a lot of extra time. It's just a fact, right? but I didn't have any time and I still made it work. I would say you need to be able to devote probably at least 5 hours a week to doing it, at least 5 hours a week. If you can do 10 hours a week, at least initially trying to build relationships and then analyzing deals, things like that, better. But if someone says, well, I have like an hour a week to devote to this, it's going to be really, really hard to do it. So I don't know. I tell people at least 5 hours a week of their time to do it. And some of that can be offline. You don't have to do it during business hours. You can, analyze a deal at, in the evening if you want to, or on the weekend. Or one thing that makes it a little more difficult for multifamily, if you're looking at syndicate or buy like a larger property, is in most cases the brokers don't work weekends. So you think you're going to look at all these properties on the weekend like you do like single family, and it's not the case. They're usually working 9 to 5 Monday through Friday. But I would say you need 5 hours or so a week to kind of really. If not, then you're just starting over every week. If you spend 1 or 2 hours like every week, you're just starting over, not really making any progress.
What's the saying? He who asks the most questions wins. So all right. So hypothetically, let's just say there was a commercial lender out there who had a lot of deal flow that had already had the deals analyzed and had the knowledge of where that debt could happen. How would someone approach someone like yourself to say, hey, I've got several of these things already teed up? How would you say, because most people don't have deal flow and they don't know the debt side of stuff.
Right.
How would you hypothetically?
So hypothetically, somebody in the room might have that, I guess. Okay.
Yes.
So
Several.
For me, two things. One, I would say, go to meetups, meet people that syndicate deals, and just build those relationships. Two, I would say, and you might already know, I would underwrite it 2 ways. I'd underwrite the deal from a lender perspective. I'd underwrite the deal from an investor perspective, because there are two different ways they're going to be underwritten. So if you already know that, that's going to be valuable. Somebody say, hey, I understand both sides. I understand people look at debt differently, and the lender's going to look at certain things. But I analyze it side by side. Investor perspective, these are the returns. Lender perspective with the debt, and then present it to somebody that syndicate deals, and understanding what they're looking for how many units, things like that. But if you can do that and you have the debt side kind of lined up, and you understand how investors look at it and they analyze the deal, then that's going to be valuable to people for sure. So I think just present it to people that do that syndicate deals, and don't give them 10 deals at once. Say, hey, what do you think about this type of deal? Pick a good one, right? And here's the debt, here's what it is, and it's valuable to people. You're providing, like I talked before, having something that you can bring a value. People say all the time, I want to partner with you or someone like you, whatever it might be, and I'm not trying to be whatever. They don't have anything to offer other than time. And time's valuable, but it's not valuable if you don't have any skill sets yet, in my mind. Time by itself is useless. You have to provide some sort of value. So what you're talking about doing, without a doubt, will provide value. Just make sure you underwrite it from an investor perspective as well. And even further, if you actually have relationships with property management companies, depending if these are off-market deals, you may not want to yet, but say, is prepared, you can come, hey, I have the debt side lined up. I talked to a property management company, confirmed the budget with them from an investor standpoint. Here's what it looks like. Here are the returns. What do you think? That would be valuable for sure.
So to close it out, can you talk a little bit about, you touched on goal setting. Can you talk a little bit about the process? I know you may have been through Robert Helm's goal setting program, but can you talk about for investors out here? I think that's a really important piece of the puzzle that we don't talk about maybe enough. We talk about how to analyze deals. We talk about what makes a good deal. We talk about cap rates and all that stuff. But can you talk about maybe just a good framework for goal setting as it relates to what we've discussed this morning?
Yeah, so I would say throughout pretty much my career, I never really put goals on paper. I never really thought I needed to ask people for help and things like that. I was like, man, if you say you're going to do it, just go ahead and do it. But that's not the norm, and you're going to be hindering yourself if you do that. To me, goal setting, you have to look at all aspects of it and kind of work backwards. For me, Tamiel and I have a goal we work a lot right now. We do a lot of deals, we educate people, things like that. But if you work reverse, say, what are my goals? Is my goal to go sit in Hawaii on the beach and do nothing? Probably not. Maybe sit there sometimes, but and really get on paper. This is what I'm looking to do. The time frame's the hardest part, because people are like, I talk to people all the time. Well, 2-3 years from now, I'm going to do multifamily. I said, well, why are you waiting 2 to 3 years? I talked to a guy yesterday. Tammy heard the conversation. The guy said, well, I made a decision a year ago to do multifamily, and I haven't done anything yet. I said, well, we'll probably have the same conversation a year from now, unless you actually change something, right? So I think getting on paper financial goals, one, but having it balanced, whether it's, you want to work out, whether you want to spend time with the kids, and all aspects of it. I haven't been to Robert's goal setting. I know I have heard it's phenomenal. But for me, I've always had a hard time because I've always gravitated more to the work side. My significance in work is like this now compared to when I did IT. That was where I got all my self-worth from. I was really good at what I did. I'm not good at a lot of things. I was really good at that. I got all my self-worth from there. Now my whole goal is to be able to help other people, build relationships that are lifelong, build family, community. Tammy used to always talk about community. I'm like, who cares? We're doing deals, right? I don't care about community. And but now for me, it can change me 180 degrees. Now we have relationships that are lifelong from people. But I think put it on paper, analyze, review it all the time, and it's okay to change it. If you're not meeting your goal, and then figure out the area you're not meeting, and hire somebody, or talk to somebody, or a coach, or whatever. I used to not believe in mentors or anything like that, all the gurus, stuff like that. But if you find the right one, they literally could say one thing that just totally transforms your whole thinking completely. But put it on paper, and that's where I'm not. And so Tammy Mitchell did a vision board for us. I never did a vision board. I actually wanted to cry. She gave it to Christmas last year. I'm like, oh, this is great. But those things, and then teaching your kids to do those things. Paige, our daughter, said she said she feels alive when she dances. That's what she put on her vision board. And she wasn't in dance. I'm like, we need to get her in dance. But I think work in reverse, where you want to be, and chunking it into small little increments. Like we've done a lot more this year than I probably anticipated. I'm not surprised necessarily, but it didn't happen overnight. It took a lot of little steps, not to go into too much detail, but the little dinky steps that you won't even see, and then all of a sudden you're like, wow, I didn't know how that happened. But it didn't just happen. It's taking those little steps, and then surrounding yourself around people doing what you want to do and asking questions. I tell our kids also, always be humbled, or you're going to become humbled. Don't think you're all that, or my deals are all great, nothing ever goes wrong with it. I've talked to more people this year, no joke, that I know that are really experienced, that have more problems with deals this year than I've ever heard before. And it's just certain reasons for it, and it's people related, typically.
So good. Well, let's give a big hand for Mark Kenney and his beautiful wife, Tamiel, for being here with us this morning. Thank you so much, man. Incredible. Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.